The inverted yield curve is basically there's a 75 basis points difference between, say, a 2-year and a 10-year treasury. And the only reason why someone would, lock their money up for 10 years at 0.75% lower than what they can get for 2 years is because they believe that in 2 years, they won't even be able to get what they can get for 10 years today.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.
Welcome. You are listening to watching the Financial Survival Network. I'm your host, Kerry Lutz. Well, Anthony Saccaro is with us. We're going to be talking about higher dividend yields, how you make money even when the economy is going to hell in a handbasket, all of these things. So, hey, we're going to get on to it. If you got a question or comment, or if something you want me to cover, a guest you want me to have on, send an email to kl@kerrylutz.com. Make sure whatever platform you're on, you like, share, and subscribe this show. It really helps the show out a lot. Anthony, it's great to have you back. So where's the economy? Inverted yield curve, Fed's not raising rates, inflation looks like it's taking a breather, but is it just a temporary breather, or are we going to see prices and therefore rates go up in the not too distant future? What's your take on all of it?
Kerry, yeah, great to be here. Thanks for having me back. Love the show. Love being on your show. I think that the Federal Reserve not raising rates was the right move. Inflation, as you know, is a lagging indicator that oftentimes takes 6 months to react to whatever the Federal Reserve does. And, inflation in May of 2022 at a high, I believe it was 9.1%, if I'm correct. Now inflation is down in the mid threes. Their target is 2%. So we've made a lot of progress at this point, but we haven't made as much progress as they would have hoped. I think it really hinges around the labor market. At this point, the labor market is starting to soften. We were having this conversation in December of 22. If my memory serves me right, Kerry, I think we were almost at two jobs for every worker available. I think it was 1.9, if I remember correctly. Now I think we're down to like 1.7. So the fact is that there's a lot it's come down. There are less jobs per worker. That number is going to need to come down. A lot of people think that the unemployment rate, which is still at record lows, that needs to get up into 6 or 7% in order for inflation to come down. I don't know that that's necessarily the case, although I believe probably 6%. But this is the recession that's never happened at this point. And, it used to be 6-8 months ago, a year ago, we were talking about a recession, whether it was going to be a soft landing or a hard landing. Now they're talking about no landing. Is it possible that we get through this with no recession at all? And I think that is possible for the first time, but I don't think it's likely. I think there is going to be a recession around the corner. I think the inverted yield curve is telling us that. Probably sometime in 2024. I think we do have to still be careful.
All right. Imagine if they threw a recession and nobody came, right?
Yeah, and interesting that that's the possibility as well too. But the inverted yield curve is telling us a different story. The inverted yield curve is basically there's a 75 basis points difference between, say, a 2-year and a 10-year treasury. And the only reason why someone would lock their money up for 10 years at 0.75% lower than what they can get for 2 years is because they believe that in 2 years, they won't even be able to get what they can get for 10 years today. And when you look at the economists across the country, you look at the experts across the country, you look at the economical data that's going on, that's out there, everything points to the fact that the Federal Reserve is going to lower interest rates in 2024. The only reason they would do that is if we have a recession, if inflation does come down, and we now need to start stimulating the economy. So I do think the odds of a recession in 24 are still pretty high, and I think you need to treat that as such when you're trying to figure out what to do with your own portfolio.
All right. So what are you telling your clients to do now at this point, Anthony?
Yeah, interestingly enough, I want my clients to be in a position to win no matter what. And that's a phrase that's kind of caught on. It's a phrase that I've been using recently because Yahoo Finance, when I was interviewed on their live TV recently, they asked me the same question. In this economical environment, with all this uncertainty and things going on with China and Russia becoming friends and wars and inflation and interest rates and so on, how do we invest in this environment? And my answer to them is, if you are invested right, you should be able to win no matter what. And I think that the way to do that is to really focus on dividend-paying stocks, because if things go well, then those stocks are still going to grow in value and your dividends are just going to be the icing on the cake. If things don't go well, then the dividends could be the answer to cancer, if you will. The dividends are going to be the one thing that you can continue to dollar cost average in, and essentially you're getting paid to wait. And so I think dividends, no matter what phase of life you're in, whether you're in the accumulation phase of life or the principal protection phase of life or the distribution phase of life, I think this next decade, you need to focus on dividends in case things are flat, like a lot of experts are predicting.
Okay, so dividends are important. I think we agree on that. But if we get like a major recession, presumably the market's going to get hit as well, right? Do we think the stock market's going to go down? What do you think it's going to go down if the recession magically appears?
Yeah, so if we have a recession, I mean, certainly the market's going to get hit. And that's the time that you are really going to value dividend stock more than anything else, because now you have the ability to get those dividends and the dollar cost average them back in and to reinvest. And, interestingly enough, if you have growth stocks and, we have a 10-year time period of, crashes and recoveries, very much like the first 10 years of this decade. Well, if you have a growth stock that doesn't pay dividends, you just have a big blah. 10 years from now, your growth stocks are going to be worth the same as they are now. Whereas if you're getting dividends, you can dollar cost average those dividends back in. And if the market goes down and you're dollar cost averaging your dividends back in, that actually helps you. It doesn't hurt you because you get to buy more of the same stocks at a lower price. So it's a very interesting dynamic. But you're not going to get dividends through growth stock. You're going to get dividends through value stock. So the dividends are what's going to help you be able to ride out a time period if we do have a lot of crashes and recoveries. And yet at the same time, if you're in dividend stocks now and the market does crash by 20 or 30 or 40%, and I think that's possible, then it might be time to reallocate at some point down the road into something that's going to be more growth oriented. But that's going to depend on your phase of life that you're in. If you're 20, 30, 40 of 20 or 30 years of retirement, reallocating some more to growth may make sense. If you have 10 or less years of retirement and you're retired, you probably want to stick with the value stocks or even shore up your portfolio in such a way to where you have maybe a smaller percentage of your portfolio in stocks and are living off the income from other things that are not stock market related.
All right. So then question becomes, what else should you be holding? What else should be in your portfolio besides stocks? How do you really protect against a multitude of threats?
Yeah. So there's a whole universe of options that are not stock related that are classified as fixed income. And interestingly enough, if you have 20 or 30 years to retirement, I would normally be very fine with you having 80 or 90% of your portfolio in equities. I think over a 30-year time period, the fact is you're going to average 8 or 10%. I'm not sure that there's ever been a 30 or 40-year time period in the market where it's ever averaged anything less than 8 or 10%. But you have to have a long time to do that. And so a high percentage of stocks makes sense, but we're at a point in time, Kerry, where the fixed income market has just been hit over the last couple of years. It's the worst fixed income market over the last 2 years, I think, in 42 years. That's for the first time you can actually buy fixed income as a capital appreciation play. So even if you're younger, even if you have 30 or 40 years, where normally I would suggest that you have the bulk of your money in stocks, I think a 60-40 plan right now works, not for the reasons that they say 60-40 is going to work, for these last decades where that's kind of been the standard mantra. I think a 60-40 plan works now for you because if the Federal Reserve lowers interest rates, that's going to cause that 40% of your fixed income portfolio to balance up because fixed income reacts opposite of interest rates. Interest rates down, fixed income grows. So you can use it as a capital appreciation play. And then potentially when the market is down and your fixed income is up, reallocate out of your fixed income into the market, and then you use that going forward, stay fully invested going forward. I don't want you to trade in and out of the market trying to make money that way. But entering the market is totally different than trading. I think you're going to have a much better entry point into the market than now. And until then, you can use anything in the fixed income category to be getting paid while you wait. In today's environment, you should be able to get 5 or 6% after fees pretty easy from fixed income investments. And there's a good likelihood that in the next 1 to 2 years, they will also shoot up in value. So great double whammy if it works the way that we think.
Okay, so high yield is your friend, but you don't want to take too much risk on yield. You don't want to put yield ahead of everything, right? You got to look for some kind of margin of safety.
100%. And the biggest mistake that I see retirees make, especially when it comes to chasing high yielding stocks, is they do just that. They're chasing yield. And if all you do is look at the yield, then you might miss the entire underlying story. There are companies out there that the price has dropped. And if you know how yields work, when the price drops, the yield goes up. And if you're an unsophisticated investor and you're just looking for yield because, here Anthony Saccaro is saying that you got to go find yield, and you get off of this interview and you go find a yield, you're like, oh, well, that one's paying, 5%, 6%, 7%, I'll get on that. Well, the reality is it might be paying a high yield because the price just dropped in value. And the question is, did the price drop in value because of just some systemic drop of what's going on in the markets, or did the price drop in value because the underlying fundamentals of that company are not good? And you may not know that. So whereas, the professionals are trying to make this determination whether a high yield is a good value play where you can buy something with a high yield and get a company that is undervalued, as an unsophisticated investor, you might not be getting a value play. You might be getting on board the sinking ship, which we often refer to as a value trap, where now all of a sudden you buy it for the high yield and then they cut the yield. And then the price goes down more, and then now you're on a sinking boat. So you have to be really careful. You can't just chase yields. You have to look at the fundamentals under the hood too, to make sure that you're getting something that's really true value, not something that's falling apart.
Very true. Yeah, you just don't go become a yield whore, as they call them, right? You need to look past the yield and really look under the hood, because a lot of these cyclicals, they pay these huge dividends, but it could be right at the end of the cycle, and then they're going to take a hit, and then they'll be cutting their dividends. So who needs that? Hey, so besides dividends and besides looking for yield, is there anything else you can do to help defend your portfolio and your wealth against the potential volatility that seems all but inevitable?
Yeah, I mean, leaving some in cash right now is probably not a bad idea as well, right? This is the first time in many years that you can actually earn something on cash. But you got to be careful if you put your money in cash too. We've talked to a lot of people that have said something like, this, I put all my money in CDs that are earning 5%. And they're excited about the fact that they got a 1-year CD that's earning 5% or so. And they come to be almost thrilled. The challenge, though, is that a lot of people are using that short-term CD for long-term strategy. And I think that's a mistake. The fact is that we do have an inverted yield curve. And if you get 5% now for 1 year, you're going to feel good for 1 year. But what if we do have that recession? What if the Federal Reserve lowers interest rates to where they were just a couple of years ago, pre-COVID, and all of a sudden your CD matures at 5% for that 1 year, and all of a sudden you can only get less than 1. We go back to the time period where, or maybe you can only even get 2. Well, that's what I often refer to as shooting yourself in the foot. If you have this money set aside, you're going to need it in a year for a large purchase, to put it down on real estate, or college, planning for your kids, or wedding, or if you're going to need this stuff and this money in 1 or 2 years, absolutely. Short-term CDs, get what you can, and then when the CD matures, you have access to the money. A great strategy. But if this is your long-term retirement plan, and you're not going to need this money for 10 or 20 or 30 years, regardless of what age you are, I wouldn't recommend locking it up, executing a short-term strategy for a long-term plan. You can get long-term, you can get 5 and 6% today net of fees by using fixed income for the long run and not just for the short run. So it doesn't mean don't have anything for the short run. It doesn't mean set it all aside. Having some for the short, having some for the midterm, having some for the long run is probably the best way to do it in order to maximize your yield. But your yield is the only thing you can count on for the next decade.
Yeah, I totally agree with you. Well, Anthony, appreciate you coming on. Tell us where we find you, how we connect with you on the web.
Yeah, absolutely. So my company is Providence Financial. You could search for Providence Financial in Woodland Hills, California, and we come up everywhere on the first couple of pages. Our website directly is providencefinancialinc.com. And if anyone watches your show and they are interested in getting a book, I have a new book, More Life Than Money, that talks about 10 different mistakes that retirees can make in retirement that they don't even know they're making. And if they let me know that they're calling in from having watched this show, I'll send them a copy of the book. Absolutely.
All right. Great. Well, we'll put that in the show notes along with a link to your site. If you got a question for Anthony, myself, it's kl@kerrylutz.com. And hey, make sure you go to the site, financialsurvivalnetwork.com, and get your free newsletter. Anthony, always a pleasure. We'll talk to you again real soon.
Kerry, thank you so much for having me. God bless.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.